Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Brett Bowman. He has been investing in real estate for 14 years, acquiring $50 million plus worth of single-family rentals, multifamily, industrial, and mobile home communities. So thank you so much for being on the show today, Brett.
Thanks, Charles. Glad to be here.
So give us a little background about yourself personally and professionally prior to getting involved with what you're doing right now in real estate investing.
Sure. Yeah. So from a just professional background, I have a finance background, MBA as well. Most recently, been working at a large tech firm. Been there about 9 years or so. Before that, was in a startup tech group, and then before that, was in a financial services company. So, for the most part, in addition to education, have corporate finance background. Personal side, I've got 6 kids, been married for a while now, and live in Boise. And yeah, just enjoy life, like to do a lot of outdoor stuff.
So when you're getting involved with real estate, why did you choose real estate, let's say, as your investment vehicle?
Yeah, great. So obviously with my finance background, I'm like kind of a nerd when it comes to investing in general, and just like can talk people's ears off about any kind of financial instrument. The thing that really got me excited about real estate, and I'm sure like many of your listeners, I read Rich Dad Poor Dad, I read Millionaire Next Door, Millionaire Mind, a bunch of other books like that just really harp into the benefits of real estate. And obviously it's a physical asset you own, you can leverage it. There's just amazing things you can do where you're getting dividends every month or cash flow every month, plus appreciation being the benefit there. And really there are far, if any, other assets that offer all of those benefits aside from real estate.
No, it's a pretty tax friendly. So can you kind of give us an overview of what your company does and
Sure.
what really your criteria and strategy is for new acquisitions and what you're working on?
Yeah, absolutely. So we started about 3 years ago as a company, but before that had been in investing individually. So my partner Ryan Hill had already been doing mobile homes and just mobile home parks. And just to kind of quickly explain how I even got into mobile home park investing, again, about 3 years ago is when I met Ryan, and I had already been doing some passive investments in industrial, multifamily, had done some single family investing on my own and things like that, and was really looking to step up my getting a little bit more active. And I had worked as an underwriter for a few syndicators. So I really started learning how to raise capital, how to work with ICC filings, how to do the background and underwriting. That's probably one of the more complicated aspects. But again, corporate finance background, that came fairly naturally for me, because it's a lot of the kinds of the same things that we look at when we're evaluating internal project investments. But so with all that being said, Ryan and I kind of serendipitously met, and he'd already had one mobile home park and was trying to buy a second, but didn't have any capital. Mm-hmm. So it was an easy way for me to make a transition from passive to active, because he really just wanted a passive investor, but ended up needing an active partner as well on it. So after we bought that second mobile home park together, I found a portfolio of mobile home parks within about 3-hour radius, which is kind of what I was looking for. We bought that with about 30 investors. So we kind of went from 0 to 100 pretty fast as far as jumping right into syndications. That was a fairly natural progression for us, just because I had done some of the co-GP work with other partners. We'd had some mobile home parks experience. Specifically, what attracted me to the mobile home park industry and just that asset class. Initially, I thought, kind of the same thing everybody thinks. Who wants to invest in trailer parks? Or I want something that I can show pictures and people are going to be proud, think it's so cool that I own that. And for the most part, mobile home parks aren't that. We've got some really gorgeous ones that have pools and clubhouses and manicured lawns, all those kinds of things. But the vast majority of them are low income housing and or affordable housing. And so they're not going to be the trophy asset. But what's really awesome about them, there's lots of things, honestly, Charles. But what's really awesome is there's so many different income streams that you can leverage that the sky's the limit. I mean, I've heard of people adding vending machines. we have people, one of our first things right away, we're able to sub-meter. Most of these parks, they pay one bill for water, sewer, trash, all of that. And we can come in and add a water meter to each home. And immediately we're recapturing amazing value because we're billing back to each individual tenant. And it's better than RUBS because they know what they can control. Yeah. So that's just one of many things. Another quick example that I love about it, I was doing multifamily before, and the typical model with multifamily is you buy this apartment complex of, let's say it's 100 units, and your plan is to evict 20 people or at least wait for turnover, and then you're going to rehab these 20 units, and then new people come in and you jump rents $200 because you've got a brand new apartment. Then you rinse and repeat until you get all 100 units rehabbed, right? And you bring them up to market. What's great about mobile home parks, you don't actually own these homes for the most part. The mobile homes are owned by the tenants, and you're often buying a park that isn't 100% occupied. So if you have a 100 unit park, maybe 80 lots are occupied, 85 lots are occupied. So there's lots of different ways to bring in new homes. And once you bring those homes in, it's like building a second floor on your apartment complex because you didn't have to evict anybody, but you still have extra income from those homes. So really lots of options for increasing income.
I never thought about the whole vacancy issue because when you're doing multifamily properties, normally you're working with a property that might be 90% occupied as you're doing those renovations. And it always really hovers around that 90%. So you have some that are regularly vacant, some that are being renovated to be re-rented out and are made ready and all that kind of stuff. I never thought about doing the value add actually with not having the cash flows really dip. So that's I've never heard of that before. That's a great point. One of the things I had a question with, and you kind of touched on it a little bit, with the park-owned homes, there's two questions here. Is like, number one is, what do I do, or what do you do when you're going into a park and you have more than what you really want? And how many really park-owned homes do you want? Or where you kind of turn down a deal, and how do you deal with that? Because as I understand it from other mobile home operators I've spoken to, that's one of the big red flags or things or downfalls is getting into too many park-owned homes, and then now you're kind of like let's say a D-class, C-, and now property owner, not a mobile home community owner.
Yeah, and I honestly, I think that's one of those things that when you're first getting into mobile home parks, you've got to decide what your model is. Some people love mobile park-owned homes. You do get better cash flow because you're able to rent out the home itself. The problems with it, though, is that let's say you're getting an extra $500 in rent for the home. You're paying insurance on it, and that insurance is probably about $50 to $70 for the home, depending on the value of the home. You're going to have to fix anything that comes up on it. You've got taxes every year on it. There's just all these things that you have to do by owning the home that you don't have to do when the tenant owns it. The other big issue is you evict a lot more when they're renting them, and they're not taking care of them. So you inevitably are going to have pretty big rehab expenses when they move out. So we prefer to not own the homes. You can't avoid it. We've got about 1,400 units in our portfolio and own about 150 of the homes, which is not by choice. So we're in the process of most of those are under rehabs. Most others were just moving into parks or getting ready to sell, things like that, because we just don't want to own them. The other thing that's really important to know is when you talk about capitalization rates as far as value goes, obviously it's based on net income divided by the current capitalization rate. Home rent is not included above the line. So it's not actually adding to your net operating income. It's below net operating income. So that extra cash flow you're getting is nice extra cash flow, but it doesn't actually increase the value of your park. So we've just decided that it's not worth the effort. And the other thing to consider as well is debt. So some banks many banks, including especially agency, won't lend if you have too high of a ratio of park-owned homes.
And what were you saying about the risk factor with that?
Yeah, so the risk is on a tenant-owned home, the national average is about 8 years that somebody lives in their home if it's tenant-owned. And then obviously they're going to take care of it better. It just their lawn's going to be nicer. They're going to be better to their neighbors, all those things. The risk if it's park-owned, it's just another rental home for those people. We evict way more often on park-owned homes because these people they often just decide not to pay the rent, or they don't take care of their lawns. They just care less. So there's just more risk to that model.
So what do you do if you're going to a park and you want to, I mean, how do you sell these homes that are there? I mean, how do you work around this process where you are stepping back from being a property or a trailer mobile home owner and just focusing on owning the park? I mean, how does that process work? Because someone to rent, it's also like on the move in too, like you're moving someone in pretty easy in rental apartments where 1 month free rent, they move in, hopefully they renew in the second year, and we've got our kind of thing, lost lease all taken care of. How do they do it? Like, how do you guys get new people in there? And then what do you do when you have too many homes?
Sure. There's like all sorts of ways I could go with that. So your first part of the question, I think, is what happens if like you buy it and you already have a lot of park-owned homes? So something that we've learned over the years, I frankly shy away from parks that have too many park-owned homes because I've learned it's hard to convert them. Initially we went with all the hubris of the world and we thought, oh, we can convert these easily. It's actually very challenging because a lot of those people love to rent. They just like the idea that you're going to come fix the problems that they have. So they're kind of set in their ways of, I don't need to own this home. So you can convert some, and we do lease to own options a lot where we finance it back to them. And essentially we try to work it out that it's essentially the same as their rent, but they're building equity. And so to me, that makes perfect sense, right? You're paying $500 and just throwing it down the drain, or you can pay $500 and we'll amortize it for you and it's yours in 7 years, for example, right? And that makes perfect sense for us, even though, it's not our home over 7 years. So over time, we're getting less cash flow. It's more value to the park because it's tenant owned, but it's still a hard sell to some tenants. So the ways we sell homes or that we convert them, one thing that's kind of come out of the last 15 to 20 years in the industry has kind of been an evolution is back in the day, and it's still done today with a lot of mom and pop owners, they just wait for people to move their own homes in. So they've got dealers, and maybe they'll make relationships with dealers and say, hey, if somebody buys a home from you, recommend they move to my park, right? That doesn't work very well. In the last year, one of our portfolios in Missouri, we've sold 22 homes there in just the last year or year to date, and only 2 organic move-ins, meaning 2 people moved into our parks without us pushing them to move in. So you can do a lot better by bringing in the home first, whether it's an old home you're rehabbing or a brand new home you're setting. There's trade-offs to both, by the way, and then selling it. And then from a sales standpoint, there's lots of options. You can do the lease to own that I mentioned before. But what we prefer to do is we work with what are referred to as shadow lenders. So these are lenders that specialize in mobile home financing. So we have 3 or 4 that we work with in the Midwest that generally we as the park owners have to guarantee the loan. So if someone defaults, it comes to us. But what's nice about that is people that otherwise wouldn't be able to qualify for a home, they're able to get into a mortgage and they can buy these homes. And even with the rising interest rates on single family, the interest rates on mobile homes are not climbing as much as you would think. There may be 1 to 2 points higher than single family, where pre interest rate hikes, they were 4 or 5 point spreads. So the spread's closing in on that. Just been interesting to see.
Yeah, that's great. Maybe you have higher qualified buyers that are now using this financing. How are you guys looking for? Is it pretty similar to what you were looking for when you're evaluating a market and going down to like a neighborhood level? Is there anything else that you're really looking for that maybe you're not looking for if you're going for renting single family or multifamily property?
Yeah, I think it's a little different. So with mobile homes, for us at least, what we're looking for is we want a MSA that's got 100,000 people in it or more, ideally more, obviously. Where I think if I was looking for multifamily, I'd probably want it to be a few 100,000, if maybe 500,000 in an MSA. I'd want it to be a lot more dense. You can get away with a little more with mobile homes because they, like I said before, they own their home, and so they're willing to commute a little bit more than they would with an apartment complex. We also look for median incomes to be at least 50,000 in the area, and single family home prices to be at least 100,000. Of course, any of those higher is way better. And the reason for that is if we're selling a brand new mobile home, we're selling it for 60 to 70,000. So we don't want to be competing with $75,000 single family homes. And then we've got rehabs that we'll bring in, and those are 30 to 50,000. So we can do that. So those are kind of the main metrics we look for. The other thing that we're big on is we started in Kansas City for a number of reasons. And so we've got our team base in Kansas City largely, and we try to be within 3 to 5 hours of Kansas City when we're buying new parks, just to be able to scale. We did break that rule recently. We bought a long-term RV park in New Orleans. Lots of reasons that still made sense for us, and we actually have a team member that's within a few hours of that. But Yeah. Anyway, that's our general deal criteria.
Yeah, that's great. One of the things you were talking about, or is are you really, you would see, and it would be a no deal for you.
Walk away. Yeah. There's a few. So we right away, before even making offers on deals, even before going to LOI, we'll check floodplain. So we want to make sure it's not in a floodplain. I don't know that that's as big of a deal with mobile home or with multifamily, because the zoning is often not there for multifamily if there's a floodplain, but you can get zoning for mobile home parks in a floodplain. So we watch for that, make sure there's not a floodplain or flood zone. We'll also check the age of the park, because depending on the age, we can often infer that the infrastructure is bad. So for example, some of the most expensive projects we've had to undergo have been water infrastructure replacements, because it's galvanized pipes or just old pipes, and sewer piping is often clay, or something else that is essentially cardboard, called Orangeburg. And so if we have that in the parks, we immediately have to ballpark hefty capex. And sometimes that can still work with the project if you're getting it for a low enough price, but other times it's a walk away. So we're looking for, so I guess to summarize, floodplain, infrastructure, park-owned homes are kind of the three big things we're checking before we even bother to underwrite it.
And that infrastructure, I could see how that could get very expensive very quickly.
Yeah. And Charles, I guess I should also say, along the same lines of infrastructure, again, another thing I don't think is common in multifamily, but is with mobile home parks, is you often are these private utilities or are they public utilities? And that's kind of a big deal, because you'll often get a well for water, and there's a number of things you can get for sewer, whether it's lagoon or septic or wastewater treatment plant. And honestly, we've had all of them. And, we've learned to kind of work with any of them, but they're just risks. It increases your risk. It increases what reserves you're going to need. For the most part, we don't like to get anything that's not public utilities, unless we're getting a killer deal. So those are some other things we look for.
Yeah. It's difficult when you're getting off the public utilities for anything, because it's just a lot of uncertainty, and it can be very expensive.
Yep.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners, and since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So you were talking about how you were kind of set up and buying so many hours from Kansas City, where you guys are headquartered. How much really goes into, once you have a park, let's just say you've purchased it, it's running, and you're doing your capex, you're adding value to the property. I mean, how are you doing it with management? How does this work? Is there someone that's on site with these parks? Is there someone from you guys that just goes out once in a while, monthly, to see these parks and make sure everything's running? I mean, how is that set up on your management? Because it seems, or it is, a lot less intense compared to a multifamily property.
Yeah, no, absolutely. I'll kind of walk through our structure. So I have two partners. One of them, Ryan, that I mentioned before, is full-time. He's been full-time working for Suncrest for the last 18 months or so. The other two of us, Matt and I, have day jobs. So he and I are able to work about 10 to 20 hours a week, depending on Suncrest stuff. And he and I each have different things that we can do that no one else works on. So we really focus on optimizing what our time is spent on. And then we have 5 other people that are full-time with Suncrest that do all of our centralized tasks. So the big things they do are financial analysis. We've got project management, home coordination. We actually have 2 people that their full-time job is homes. This is buying, moving, installing, selling homes. So we really centralize as much as we can. And we have a team of virtual assistants. We actually just hired some or some contractors, I should say, in the United Kingdom, but we have others in the Philippines and India. So all of those, between all those resources, we're able to centralize tons of stuff. So our people that are on the ground don't have to worry about bookkeeping. They don't worry about collections. For the most part, they don't have to worry about any kind of evictions. We do most of that other than delivering the letter. They can do it. We handle like taxes, all that kind of stuff is us. So then we have on the ground, we have community managers that are part-time. I don't think we have any that are full-time. And they get lot rent for free. So that's worth $300 to $500 a month, depending on where they're located. And then they often will get some kind of stipend. So on average, we're probably paying between lot rent and the stipend, we're probably paying about 11 to 1,500 a month to these park managers. And they're mostly walking the park, making sure things are safe, looking for violations, things like that. We do a lot though from a centralization standpoint to make sure, I guess, Charles, you asked, sorry if I'm a little over the place here, but you kind of asked like, what's the effort that you put into the parks, right? And it definitely depends on the park. So we've had some that we buy and 3 to 6 months later, we're hardly doing anything with them because we've onboarded them. They're a well-oiled machine. We've got everybody on auto pay. We've got a strong entrepreneurial operating system. You probably have talked about that. I can talk more in detail if you'd like, but where we know if there's hiccups that come up, we can address them. And then we have others. One of them in particular, we bought it over 2 years ago, and we still spend a ton of time on it every single week because it still struggles, right? Like it's been one of those that had bad sewer, bad water, bad electric. We had lots of sex offenders in there. And so we knew from the beginning it was going to be a nightmare, but frankly, it's been a bigger nightmare than we thought. So we're kind of at the end of the tunnel on that one. We're almost good to go there, but it varies. And that's why you do a lot of due diligence to make sure you've got a solid plan, because no one wants to be spending 2.5 years to stabilize one property, where we've got, 24 now. And I'd say at least 20 of those were stabilized within 6 to 12 months. So it's, it varies.
Yeah, I was going to ask that. That's one thing that's when you're talking about the sex offenders. Of course, we do like a lease audit when we're buying an apartment building, so you know who's there, and we have an idea of who we think is going to go bad and how much we put in reserves and all this kind of stuff. How are you guys doing it? Because that would be the last thing I would be worried about. Do you guys review who's in these homes if you're going to own them or if they're already privately owned?
Yeah, for sure. So we get the rent roll. We do check we have a sex offender check that we do. We actually, one of the things we added recently to our PSA property, why can't I think of what that's called? The contract.
Yeah, purchase sale agreement.
Property. Thank you. One of the we've added 2 things to that that give us a lot of flexibility on that. So one is that we say the seller actually has to evict all sex offenders before we close. And we haven't had any of them disagree to that yet, which has been nice because, you find one and it actually gives you extra time too. So it gives you a little bit more due diligence timing. And then another one that we did actually that's kind of unrelated, but it has helped us a lot is we negotiate in the contract that the seller will also increase rents before we close. So 30 days before we close, we do a $20 to $40 rent bump. It's not huge. We never want to go to market. We like being below market because it helps us sell homes faster. But what's cool about that is that not only does that help us walk into some equity, but it helps the appraisal, it helps the financing, all those kinds of things are better from that.
And you're still paying the old valuation before. So that is a very good element. That's a really good, yeah.
The other thing is you're not the bad guy to the residents. The seller is. The sellers who raise the rents. So there's some nice parts of that.
Interesting. Yeah, that's great. That's a lot of great information. One thing on a side note is, if I am correct, I think Warren Buffett or something invested into a company that finances mobile homes. Is that correct?
Yeah. So Berkshire Hathaway actually owns, it's 3 different companies. Let's see if I can get them right. They've got a home manufacturer. I think they own Clayton Homes. They for sure own one of the manufacturers. I think it's Clayton. And then they own a shadow lender and they own a park lender that loans on parks. So they're very into mobile home parks.
So what would you say, you've been in this for years, many different parks. What are common mistakes that you see mobile home investors make?
I've mentioned a few of them in the red flags. I think it's easy to think that you can take on the world. And that, like I said before, we've made the mistake of buying parks where we were convinced we could convert all of the park-owned homes within 2 weeks, right? And that's just not possible. So I think it's easy to think that you can, do some of these things, and you got to just really hedge and really be conservative with your estimates. It's much better to assume that you're going to convert, a third of them and actually get to 50%. Then assuming you're going to convert 100 and get to 30%, So just being conservative on that. I think the infrastructure is another big one. I've seen people that don't even check the pipes. We always have plumbers go in and scope the entire park because, again, you're better off knowing if there's leaks or if there's aged infrastructure. And sometimes you can get a retrade on that too. If you know it's going to cost 100K, you tell the seller, I'm walking unless you give me 100K for this or credit for it. So it's way worth the time and effort to do that. Those are probably the two biggest I've seen, though.
Yeah, infrastructure with just something on older multifamily too, and I've had it happen on older properties I've owned, and it's expensive. It's extremely expensive for updating old plumbing, old electrical. I mean, it's and you're just like patching it too. I mean, because something, you know what I mean? You're putting old connected to new, and it's just it's a whole mess. So kind of as we're wrapping up here, any advice you would give to anybody aspiring, other than avoiding those red flags that we've been talking about and mistakes? Any advice you'd give to aspiring mobile home investors?
Yeah. So something I didn't really talk about at the beginning, but the way I personally made the transition of doing the single family homes and kind of doing my own thing to getting into the bigger scale was by partnering. So I first found a couple of people that were already doing it. So had somebody in multifamily, somebody in industrial, and somebody in mobile home parks, and I offered to be their underwriter. So they paid me $0, totally did it for free, but I learned a ton from it. And I mean, I'd be working nights and weekends. It wasn't the funnest thing in the world, but I learned so much. And so I think, like for me anyway, it helped me a ton to just volunteer my time to these people that knew what they were doing and learn from them. And so I guess in the same vein, partnering is really helpful. And it can be I think a relatively easy way to do it is to be a passive investor first. And you can do that either by doing what I mentioned before, where you're kind of a junior like mentee doing some work for free. Or you invest in a property and make it clear to the partner that you want to kind of be involved and learn a little bit. There's some legal ramifications to that, so you got to kind of discuss and figure that out with the sponsor. But if I had to have investors that are interested in like learning and understanding our business plan and our decisions, I'm more than happy to share. So I think those are good ways to go. And then joint ventures can help too. So for me, I like to start it by partnering with people that have done it before and know what they're doing versus just figuring it out on my own.
Yeah, it makes perfect sense. So as we're finishing up here, what are some of the main habits that you've integrated into your life that have contributed to the most of your success?
Yeah, so something I've learned over the last 18 months, especially, I read a few books about like kind of stoicism, which is just this philosophy of like controlling what you can control, don't worry about things you can't, and just kind of being present, right? And these are all things we've all heard and know from before. But what I've been amazed by is over the last 18 months, I've focused on like turning off my alerts on my phone after a certain time of day. And I still see stuff. I'm still checking it every 30 to 60 minutes to make sure I'm not missing anything really urgent. But it helps me be more present with my family and my kids, and it helps me feel more refreshed for the next day. Which has been huge. So I think that's been big for me. Because before that, it's really, I've got a full-time job, got 6 kids, and then I'm also doing the real estate stuff and have partners, have investors, all those things, right? It's really easy for me to become overwhelmed and stressed and all those kinds of things. But focusing on kind of, this is my work frame, when I'm going to work, and just kind of time boxing a little bit more has helped me tons. The other thing that we kind of mentioned, or that I kind of mentioned before, is the EOS, or Entrepreneurial Operating System, from Gino Wickman's book Traction, has been massive for us. We implemented that about 2 years ago in our company. Everybody follows it. We all have the same language. We have meetings every Monday that like really follow that. And that has streamlined the amount of meetings I need to be in because everything's kind of consolidated into the most important things of the week or in that meeting, and helps us all like talk about what's most important, big issues, our rocks or our goals for the quarter, all those kinds of things. So I could ramble more here, but those are kind of the big things that I would say habitually have helped me a lot.
No, it's a lot of great information. The interesting on the stoicism is that Tim Ferriss is a huge proponent of that as well. And if you ever listen to him in an interview, he always talks about that as some of his most important literature that he's read. So, Brett, with us finishing up here, how can our listeners learn more about you, your business? I know you guys have some open funds now.
Yeah, absolutely. So our website is suncrestcap, short for capital.com. So suncrestcap.com. And then my email address is Brett with 2 T's at suncrestcap.com. I'm also on LinkedIn, so feel free to reach out any of those ways. We do have an open-ended fund that we're raising for off-market RV parks and mobile home parks now. So reach out if you're interested.
That's great. Well, thank you so much for all the information, Brett, and looking forward to connecting with you here in the near future.
Absolutely. Thanks again, Charles.
Talk to you soon.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.